Sentiment plays a dominant role in the general direction of the market. Positive sentiment shifts markets higher and can lead to irrational exuberance. The flip side of this is also true. Negative sentiment can cause a market to become oversold and thus provide brilliant investment opportunities for the patient investor. But to do so, one does need to understand sentiment. So welcome, gentlemen, to the show. Thank you so very much. So do we understand sentiment? I think we've had amazing lessons since 2008, haven't we?
Well, I don't think we understand sentiment, and I think that very few investors do. And I think there's a whole horde of stuff that kind of lies at the periphery that makes investors not understand sentiment. I'll give you a classic example. Late last year, I tried to go around the country and I asked a whole bunch of investors. I said to them, how do you feel about the globe? Do you think 2012 is going to be better than 2011, or do you think it'll be worse? And almost always people said it'll be worse. And you do exactly the same thing now, and I've just done that around the country, and most people now believe it's either going to be the same, if not slightly better, than what we saw in 2011.
So let's just survey quickly.
Well,
who thinks is 2012 going to be worse or better than 2011?
well, I mean, I think it'll be better than 2011, and that's predominantly because I look at the past returns and I say, well, if you've had a flat return out of markets in the previous year, markets have to play a predominantly catch-up role as far as
slightly better.
As trying to get. So I think it'll be better this year.
Roland?
Absolutely. I think we have to bring into the debate the very important issue around market efficiency, because in the past people believed that if markets are efficient, you shouldn't have these irrational bubbles in the market because the market should always be fairly priced. But I think very much the research over the last 15 years is showing us that there are these structural periods where markets remain expensive or remain cheap. I mean, we've had now since the subprime crisis this sluggish kind of economic recovery. So there's definitely mood swings in the market that we can measure, and that's where the focus is. And how do you quantify those sentiment moves? Because it's quite a fluffy concept, but there are models to try and isolate the sentiment.
Do you think that sentiment is actually, I mean, it's really difficult. Markets perhaps are not really as efficient as they should be because we keep seeing artificial stimulus.
You wouldn't have the 87 crash if markets were efficient, because the market would gradually adjust higher and
Absolutely, so reset itself, right?
Absolutely. I mean,
and also with this artificial stimulus that we see coming through, does this also change the fundamental factors?
You know, I think the artificial stimulus is necessary because you've got a political, you've got an economic crisis that's playing itself out globally, and you need the stimulus, because without the stimulus you'll just have a depression. So this is literally a political agenda saying, well, how do we save the system? What is it that we're going to do to save the system? Whereas irrational exuberance for me is where people become so enthralled by owning a company or by owning a certain asset class that they just forget to they just want to participate because they just think returns will get higher and higher and higher. But then the reverse of that happens as well. I mean, look at your screen quickly and you'll see a what do I call a non-valuation driven emotional cycle. So now this is the market dropping in value, as you can see over there, and that's the market rising in value. So you know anybody like this, anybody that makes a decision like this, the market starts dropping, people say, oh, don't worry, we've seen a drop like this before. Drop some more, was it this bad? I wonder how John's portfolio is doing. You always do a relative when things get tough, right? You always do a relative. You always say, is it maybe better or worse elsewhere? And as it drops even further, this is a mess, God, I've been this wrong. And right at the bottom, you say, I should get out. I should never have trusted my broker. I should never have trusted actually people that invested my money. And actually what you should be doing is you should be following what's called the valuation-driven emotional cycle. And look at your screen now. You'll see the valuation-driven emotional cycle. As the market sells, you say, this volatility is better avoided. Wait, can there be more? And you slowly and gradually start allocating money to the asset class losing money. And then at the bottom you say, well, it's even better at these levels, and you upweight for the second time. Now, how many people do you know that actually invest like that? I mean, Lenny, how many people do you know?
So just changing perception of the bad time. You know, when I see these graphs, it actually reminds me of my emotions on a day-to-day basis. So human behavior, I'm glad you think it's funny. Human behavior can be directly linked to a lot of these cycles. It is all about how you respond to the negativity.
The challenge is also the length of those cycles, because unfortunately they are not as evenly spaced across time. It was in '96 actually in December when Alan Greenspan made his speech and used the words irrational exuberance. And that was 4 years before the 2000 market crash, the tech bubble basically bursting. So we had 4 years of irrational exuberance, which is a long time to be wrong either way. So the cycles don't always pan out exactly the same. So that's the key trick. Is we sometimes know that markets are irrationally bearish or bullish, but when is it going to turn around?
Okay, but what is your view right now? Alan Greenspan then, after the crash, kept interest rates very low for an extended period of time, which perhaps created more irrational exuberance.
Exactly.
We're fixing the same with the problem that with debt, the same thing that created the problem. Are we now in irrational exuberance once again?
I think we never thought about irrational or market sentiment previously. Because we didn't look at, we assumed markets were efficient. So a lot of the issues like leverage and the cost of money, especially when money is cheap, is a critical component to driving that market sentiment to irrational levels. So at the moment, we are seeing a lot of money being printed. We are seeing the rise of inflation coming closer and closer. But I do think that at the moment, most economic indicators in the US, to some extent in Europe, are looking quite positive. So you currently are in a positive sentiment upswing, but the economics are not looking that great. So at the moment, there is still slowing growth in Europe. We are worried about Greece defaulting. So they're big macro issues, but the sentiment is definitely
because
looking
Greece
positive.
accounts for such a big percentage, of course, of the Eurozone.
Yes.
It's very important.
You see, you make it personal again, you see.
Not at all, Kobie, I'm just stating facts here.
I think the thing that you're seeing at the moment is pessimism turning into some form of optimism. And that's why you're seeing money starting to flow back into equity markets. The whole Greek issue, now that you've raised it, okay, is still back burner. It's gone back burner. It's not front burner at the moment. So the fact that it's on the back burner, it's not solved. There's nothing that's solved at this stage. It's just they're just rejigging the debt puzzle.
The optimism that we've got right now, based on fundamental factors, we see earnings that have recovered quite nicely. Balance sheets are looking much stronger. Or does it really have to do with the fact that we keep talking about it's a crisis of confidence and all this liquidity that we've seen pumped into the market now is creating a better sentiment?
Okay, but this is where the good investor comes in, because the good investor sits down and says, okay, what are the facts? The facts are that balance sheets are looking pretty good. The facts are that globally, valuations are not bad. You've got to go and look around, but valuations aren't bad. As a matter of fact, on a decade basis, valuations are good. You've had no returns out these markets. So at some point, if you are serious about owning businesses, this is a good time to own businesses. Now put this into a consulting type of role. Your client is sitting down and saying, I better start creating returns. I have to create returns. How am I going to do this? You say to a client, are you serious about owning businesses? No, I want returns. You see how different those two mentalities are.
Don't you think it's also a lot of short-termism, if I could call it that, relative to what we see in the long term? Because also in hindsight, we say, well, we shouldn't have been that dramatic, and we shouldn't have actually responded, with that
hindsight
knee-jerk
is always 20/20. But you're absolutely right that sentiment is much more of a short-term effect, but it is a very important effect in the short to medium term. In fact, there's lots of research to show that our traditional fundamental valuation models using price to earnings ratios, dividend discount models don't actually work over a year or two, because PEs and dividend yields mean revert only over 5 years or longer. So you have this mismatch where the tools we're using to value companies in the market only work over much longer cycles. And in between, sentiment is the swing factor.
But that's
and we
where you
don't
get
have the
opportunity,
tools.
though.
That is exactly where the opportunity is. But we don't have the tools necessarily to quantify where we are in the sentiment cycle over and above the business cycle.
To show you maybe some of those tools and just to understand maybe a little bit more about those, have a look at your screen at the moment. I'm showing you the South African market since 1925, and this is up to the end of 2011. And you'll see that I look at the rolling returns over different holding periods. So in the first portion of it, I'm holding equities over a year, and then I extend it to 2 years, and then right at the end there you see a 10-year holding period. Now if you decided to hold equities, say for instance over a year, what are the kind of returns that you could potentially be getting out the market? Well, you could be doing as bad as minus 40, just more than minus 40% there per annum. That's a rolling 12-month return. Or you could potentially be doing 120%. Now you sit in a situation where, the guy stands on the golf course, he says, I've made 120% out of equities. How often does it happen? Well, not often at all. How often does minus 40 happen? Well, it does happen, and that potentially maybe becomes a buying opportunity. And that's sentiment. Look what happens when you start holding equities over longer periods of time. You'll see that returns actually start becoming progressively more certain over time. And you can see the red dots that I've indicated on the screen over there. Those are the average returns over time. Let me show you exactly the same picture, but let me now apply it to the American market. And there you can see what the US market looks like. You can see that over any 1 year, you see that equities could do as bad as minus 60%. You know, South Africa only minus 40, America minus 60, the proverbial 120% at the top. But you can see that returns actually become positive over time as well. Interesting to see that over a 5-year period, you could still be sitting with a massive negative return per annum if you had been invested in the US market. So there you go. That's sentiment. And it's trying to ensure that sentiment actually shifts in your favor so that you can make decent investment decisions. And that's the job of an investment team. So if you've got an investment team, that's what an investment team should be doing for you.
Roland, I mean, also these exacerbated moves that we see to the up and to the downside. We talked about opportunity. How do you make those decisions when you say, okay, things have run way too hard. I think I should, go, give some equities up to buy a few bonds and then diversify further. How do you make those decisions? Because that's also very much emotionally driven, because you've got this hope that yes, it'll go to the sky, it'll go to the moon.
Well, there are two issues you're discussing there. The first is an asset allocation decision, which is a risk management, very important risk management input to the investment process. But sentiment is over and above the asset allocation. Within the asset class, you can have periods of irrational exuberance in equities. So not only do you have to time your asset classes if you want to manage risk over time, you also have to be able to, within the equity universe, know if equities are expensive or cheap. Now, the way that the research is looking at this problem is that they are saying that there are two components intertwined in the all-share index or in the market. So if the market does 20%, fundamentals, you can measure the contribution that fundamentals make to that return. So if you look at interest rates, earnings growth, and the typical kind of fundamental measures, they'll explain of that 20%, let's say 15%. So there's 5% that you can't explain with the fundamentals, and that is the irrational component. Yeah. That is the market going up higher than the fundamentals can actually justify. And there's sort of statistical techniques such as regression that allow one to isolate the rational from the irrational, and you can actually get an idea of if the market is positively overreacting.
People say to me, how do I make money out of markets? How do I do
make money out of markets, Kobe? That's great news.
Of course, absolutely. Why am I on the show, Eleni?
You can tell us about your returns next time.
Yeah, absolutely. Next show, we'll be doing a show on
Kobe's portfolio
returns and how those stack up. Listen, I think the important thing here is people say, how do you make money out of markets? Yeah. Understand what you want to own. What businesses are you most passionate about? What do you want to own? Why do you want to own those? And then wait for an opportune time to buy those. And there are some classic examples at the moment that are available. They might not always be around, but they certainly are available.
I mean, is construction one of them?
Well, construction in South Africa at some point has to turn around. You know, you could have bought construction of lower levels, for instance, 4 or 5 months ago, but at some point this has to turn around. I'd like to use an example, consumer staple stocks in the US or consumer staple stocks in Europe. Europeans, regardless of how bad it gets, still need to eat. They need to go to the corner shop and they need to buy bread and they need to buy milk. I don't care how bad it gets, you need to eat.
Okay.
Those are some classic examples of some fantastic businesses.
I mean, that's on the international front. I mean, where are you seeing value right now?
I think we certainly, if you're looking at valuation measures such as price to earnings and things like that, you certainly are seeing that resources are much cheaper than they used to be, especially relative to industrials at the moment.
Are you talking diversifieds, or are you saying across the board?
I'm talking across the board, sort of a sector allocation kind of argument. So there's definitely value there, but the problem is that PEs only mean revert over 3 to 5 years. So is now the time, or is it going to get cheaper? And there's a lot of macro risk at the moment, so the best is actually to, I think, wait and see till this Greek story is sorted out.
And March is quite an important period. I mean, that could take a long time. I mean, obviously March is very important.
There are certain milestones that you should always be careful of investing before a big macro milestone. At the end of March, there's a lot of Greek debt that is falling due that has to be refinanced, and if they can't refinance that, and obviously they're trying now, and the news is looking good that they will sort this out, but in the next 4 weeks, we have a milestone that you don't want to go and make a big asset allocation or sector allocation decision before.
But you're still expecting, I mean, the beginning of the show you said 2012 is going to be a better year.
I think the first half in 2012 is certainly where you're seeing the buoyant sentiment underpinning the market, but the macroeconomics are not looking that great. So the second half of the year is probably not going to be very strong and will be quite mediocre.
And we're talking about this, resource space looking very attractive relative to what we see in the industrial space, and it's very evident in the JSE All-Share where we've seen it hit a new record high, but the top 40 index hasn't hit a new record level as yet, and that is because it's heavily weighted to resources.
The big miners are still trading off single multiple multiple price to earnings ratios. I mean, and you can go and actually go and pick the different kind of earnings cycles and so on. You can go and, but I mean, it's not just a phenomenon here in South Africa, it's a global phenomenon. So if the world is going to start growing, where are they going to buy the resources from? Are they going to have to buy it from from the big mining houses, of which we've got prime examples in this country? Surely that must be an opportunity that at least you want to start having a look at. I mean, I agree with Roland. I mean, there's certainly in an asset allocation argument, you need to at least have some cash available, because there are things that are unknown.
Are you lightening up on equities at this point, Kirby?
No, I think, I mean, if we look at from a total portfolio construction perspective, we've actually started buying. And we've bought. And I think internationally...
Please tell us what.
No, absolutely not.
Well, I hope you'll be more telling.
Yes, I think everyone is nibbling at resources now, so I think that is probably your easiest hunting ground. The kind of resource stock that you probably want is a low beta or a defensive kind of resource stock, because if anything happens globally...
so you'd want an Anglos or a BHP?
An Anglo Gold is quite a low beta kind of resource stock. It's got a beta less than 1 to the resource index, so it actually moves in smaller steps than the overall
So you would buy a gold mining company?
I think so, yes. I think they are much cheaper than they used to be, and the resource sector as a whole is quite dominated at the margin by the gold mines.
I think we should move to fund focus.
Okay, so let's take a short break. Given the fact that Kubi will not divulge what his recent buys are on the equity market, while you at home take a short break, Kubi Lachanje and I will be debating whether he's going to reveal his buys, and then we also focus on the Ford International Trust. We'll see you right after this.